back to the channel. My name is Sally, I'm from Gillard Studios, and today I'm going to talk to you about the process of setting up in business as a photographer or a photography studio, because there is more to running a good photography studio than taking great photographs. So today I'm going to cover the differences between being a sole trader and a limited company. So if you're looking to set up, whether you are looking just to set up as a small scale photographer, set up a large studio, or any other business for that matter, and you want to know the key differences between being a sole trader and a limited company, then listen up, because I'm going to cover that in basic terms for you today. Okay, so the first thing I'm going to briefly touch upon is that £1,000 trade-in allowance that we do have here in the UK. So every individual is allowed to make up to £1,000 in sales before you register that business, and that renews on an annual basis. So if you're only making less than £1,000 in sales per year, there's nothing that you need to do. However, as soon as you reach that £1,000, and like I said, that's not profit, that is sales, you do then need to register that business in some form. And the most common ways that people will register a business is either as a sole trader or as a limited company. So the first thing I'm going to touch upon is a sole trader. A sole trader is the simplest form of setting up in business, and all you're doing is registering for self-assessment with HMRC. And that basically means that every single year they will send you a letter telling you that you need to complete your self-assessment and that you will then be due to pay any taxes owed for that period. Now, you can run that accounting period for whatever dates you wish from the date that you start your business. So say, for example, you start your business on the 1st of November 2024. Your accounting period will run from then till the 31st of October 2025, and you will have until the 31st of January 2026 to submit your self-assessment form and to pay any tax due in that time. So it's really simple to manage, and definitely one of the best or one of the biggest pros of going as a sole trader is just how easy it is to do that. Obviously, you do need to be on top of putting aside money for your tax bill, but other than that, it's really straightforward, and there's no stress involved of running a company as a sole trader in that effect. One of the things that you do need to be aware of, though, is the first year that your tax bill goes over £1,000, they will also ask for 50% on account for the following year. So if your tax bill is £1,000, they will want £1,500, and then by the 31st of July an additional £500, because they want to be in a position where your tax is up to date. So that first year where your tax bill goes over £1,000 can be a little bit of a stinger, but other than that, it's really straightforward and simple to do. You can do them yourself, or you can get an accountant to do your accounts for you if you wish. But a sole trader self-assessment is relatively straightforward, and a lot of people do tend to do it themselves, although an accountant can help with things like depreciation costs on equipment and helping you save more money on your tax in that way. So weigh up the pros and cons of whether you want to do it yourself or whether you think it's worth enlisting an accountant to help you with that. Now, the biggest negative of running as a sole trader is the fact that you're not creating that legal separation, and that means that you're not going to be limited from any liability. So if you take out a lot of debt for your business, once you've taken that debt out, you are personally responsible for that debt, even if your business fails. So it's really important that you make sure that you're not taking out an excessive amount of finance for your business, and that it's affordable for you to repay, even if your business does happen to close down, because that debt is going to follow you. So yeah, that's pretty much it when it comes to being a sole trader. In terms of the tax involved with being a sole trader, it's very similar to if you were an employee in terms of the rates that you pay, although it is slightly different. Your income tax rate is the same at 20%, and the higher income tax bracket at 40%. You have the same personal allowance of just over 12,500. So you'll pay 20% in income tax on everything over that amount, and then 40% on over the higher income tax sort of bracket. In terms of national insurance, then that is slightly different. The national insurance contribution amount at the moment is 6% on self-assessment, on self-employed income, and you will need to pay that alongside your income tax bill as well. So a total of a roughly 26% of everything over 12,500 and up to that higher income tax bracket is what you will need to pay. So what I always recommend that people do is that they monitor their income through an app, something like QuickBooks or Xero or Sage 1, for example, so you know how much is coming in and you know how much is going out, and then start putting aside that money for tax, so that when that income tax bill lands, once you've done your self-assessment, you'll be fully prepared and you'll have that money just to pay that bill and forget about it. There's nothing else that you need to really do other than that when you're a sole trader, because you are not that sort of separate legal entity. You can, other than making sure that your tax is paid, you can manage that money as and when, as you wish. So you don't have to have a separate bank account as you would with a limited company, although I would definitely recommend it. That pretty much covers the basics of being a sole trader. So I'm just going to move on now and cover a little bit about being a limited company by share. So moving on to a limited company then. So when you register for a limited company, you've got to register with Companies House. Currently that's £50 to do it online, or £75 if you do it via post. Now, one of the main differences between being a sole trader and a limited company is how regulated it is to operate a limited company. So when you open your limited company, if you're a one-man band, you potentially be the only director and the main shareholder for that company, and you've got sort of overall and sole responsibilities for that, and you do have some statutory and fiduciary duties. So you're regulated by the Companies Act of 2006, for example, and then you've also got the statutory responsibilities, which includes things like making sure that your accounts are submitted every single year, confirmation statements are submitted, making sure that any changes within the company are notified to HMRC within a certain time frame and things like that. Make sure that the tax returns are completed. So I would definitely make sure that you've got an accountant helping you with all of these things, just to ensure that you are meeting those sort of statutory duties as a director of a limited company. Now, in terms of how the tax is paid as a limited company, that's slightly different as well. So you would pay corporation tax on your company profits. Obviously you can pay yourself a salary, so you'd need to register yourself for PAYE as well. Your salary will count as an expense and reduce your sort of corporation tax. But the other way that you can take income, which is through the form of dividends, that doesn't reduce your corporation tax. So that is paid after the fact. Now, dividends then, if you are paying yourself in dividends, you will also need to register for self-assessment to declare those dividends, and dividends are taxed at a rate of 8.75%. So you've got a couple of different taxes that you will need to pay as a company director. So you'll need to pay income tax if you're paying yourself a salary of over that 12,500, plus your national insurance contributions as an employee and employer's national insurance as well. You'll also have your corporation tax to pay, and you'll also have dividends tax to pay on top if you are taking out dividends as an income from a limited company. So it does create a bit of a complexity around how you are withdrawing your money from the company as a limited as a shareholder or a director of a limited company. So unlike with a sole trader, you can just nip to the shop and use your business card as and when you please. You can't do that as a limited company. You can only remove money from your company accounts via those certain ways, and that's got to be done properly. There are other things you can do, like directors' loans and stuff, for example, if you're lending money to your business. But it's definitely worth having an accountant who's going to talk you through that process and what that means for your business and what taxes that you will have to pay. The main benefit of being a limited company really is the limited liability that comes with it. So obviously, if your business failed, you're not going to be personally liable for any debts that your business does hold. However, in the first few years as a limited company, now it's becoming more and more common that if you were to go down the route of borrowing, they are asking for personal guarantees as well. So just be mindful of that. If you do take out some borrowing as a limited company and think that you can walk away if all fails, chances are, if you are an early limited company or in the early days of being a limited company, you're going to be asked for that personal guarantee, which means that it's going to give you the same risk responsibility as if you were a sole trader in that case. So that's something to definitely be aware of and keep in mind. The other thing would be in a director of a limited company, your accounts do go on the public domain. When you're a sole trader, you haven't got to worry about that and it all stays private. But as a limited company, your accounts will be publicly available online for anybody to go and have a little look at. Now, from a tax perspective, a lot of people think that they'll pay less tax as the director of a limited company, and this can be the case if your profits would push you into that higher income tax bracket as a sole trader. But if you are within that 20% income tax bracket, then typically you're going to be better off staying as a sole trader for tax purposes. So it's not going to give you any sort of financial benefits of being a limited company until you're, you know, earning a significant amount of profit where it's worth you then splitting your, you know, splitting it down to a salary and taking dividends and paying your corporation tax, for example. So it definitely would be worth staying sole trader that little bit longer until you reach that point, unless you really do need to, you know, protect some assets or something, for example, which you would need to discuss with an accountant and a financial advisor to see, you know, to weigh up the benefits and the cons of doing so. So yeah, that pretty much gives an overview of the differences between a limited company and a sole trader. Just a couple of myths to bust before we wrap it up today. So a lot of people think that if you go as a sole trader you can't employ staff. That's not true. As a sole trader or a partnership, you can certainly register for PAYE and take on staff, so it doesn't avoid that. And a lot of people think also that you can't be VAT registered if you're a sole trader, which again isn't true. If your turnover does go in excess of the current threshold, which is £90,000, you would still be liable to register for VAT regardless of whether you're a sole trader or a limited company. It doesn't limit that in any way. So I hope that has helped a little bit break it all down. Overall, for me personally, if you are a small business under that 40% income tax threshold, then likelihood is staying as a sole trader or registering as a sole trader is going to be your best option. If you're going to have a really large turnover, lots of assets, high profit and things like that, then maybe a limited company is going to be the best option for you. Maybe we'll cover a little bit more about VAT in another video, but if there's anything in particular that you want to ask about running specifically a photography studio or any small business, then please do let me know in the comments. And if this kind of content does interest you, then do me a huge favour and hit a like on the video, and also drop us a subscription as well. We are going to be bringing more and more content on the business side of things, as well as on the creative and photography side of things as well. I hope you've enjoyed today's video, and we will catch you in the next one. Bye.